This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 376 was produced on May 18th, 2023. I'm Erik Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Variant Perception CEO Tian Yang returns as this week's feature interview guest. We'll discuss the long-awaited U.S. recession and the final flush in U.S. equity markets, which Tian says is still to come. Tian will also share a non-consensus view on gold, which I think you'll find very interesting.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, May 17th, 2023. The S&P 500 was up 50 basis points, closing at 4171. We'll take a closer look at that chart and the key technical levels to watch in the Postgame segment. The U.S. dollar index up 140 basis points, closing at 102.90. The dollar has clearly started to strengthen off the lows. The July WTI crude oil contract up 40 basis points, closing at 72.83, seems to be settling down after a very volatile few weeks. We'll look at that chart, and Erik will have the EIA inventory data in the post-game segment. Gold down 260 basis points, closing at 1985, the price taking a breather after testing all-time highs. Copper down 230 basis points to 375. Dr. Copper continues to show short-term weakness, and uranium up 80 basis points to 53.75 and continues to hold the breakout and press to highs of the year. The U.S. 10-year Treasury yield up 13 basis points, closing at 357 points. Key news to watch next week, we have global manufacturing and services PMIs, the FOMC meeting minutes, and the U.S. core PCE index. This week's feature interview guest is Variant Perception CEO Tian Yang. Erik, why did we get Tian back on the show as a guest this week?
Well, we've been looking for guests who are well qualified to answer three questions. Whether the final bear market bottom is already in or still to come, where inflation and rates are headed, and where we stand in the overall commodities cycle. Variant Perception is known for their work on leading economic indicators, and they've also had several good market timing calls. So it seemed like a perfect match, and frankly, we were also a bit overdue as we realized it had been a year since we had Tian on the show. So it's great to get him back.
Well, Erik's interview with Tian Yang is coming up as Macro Voices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's your host, Erik Townsend.
Joining me now is Tian Yang, CEO of Variant Perception. Tian prepared a terrific slide deck to accompany this week's interview. Variant Perception is very well known for excellent graphs and charts, so you're definitely going to want to download this one, folks. You'll find the download link in your Research Roundup email. If you're not yet registered and don't have a Research Roundup email, just go to our website, macrovoices.com, and click the red button above Tian's picture that says looking for the downloads. Tian, it's great to get you back. It's been way too long. Why don't we dive into the slide deck and start with this U.S. recession that so many people have been anticipating for so long that hasn't happened quite when everybody expected it. Is it finally time?
Yeah, well, firstly, great to be back. And yeah, I think this is a very good time to review a lot of the leading indicators for the US economy. I think when we talk about recessions, definitions are important. And a lot of times there's a lot of focus on what we would consider coincident or lagging data. So, people look at the, employment, non-farm payrolls, retail sales, GDP. Generally speaking, these are coincident indicators that by the time you see it, is usually kind of too late. And a lot of the underlying recessionary dynamics have already kicked in. So I think the way we think about recessions is to really focus on the leading data. And broadly speaking, if you consider, kind of classic lead indicators of the business cycle, building permits, ISM manufacturing, and so forth, a lot of them have obviously been signaling stress for a while. And the kind of final missing piece has been the initial claims and the continuing claims data. Normally, it takes kind of a 20% rally off the lows for these indicators to align with recession. And, given the big data revisions that occurred last month, it's now pretty unequivocal that the labor market data in terms of the leading parts are all signaling kind of stress picking up. And that usually is what you expect to see as the kind of final piece that confirms a recession. So it does, from the data kind of modeling side, it does look a lot more recessionary now.
And how does that translate to an equity market outlook? Is it time for this market to finally roll back over? Is the bear market rally finally done?
Yeah, so obviously at this point, we're kind of quite a long way into the start of the bear market. So, it's not going to be easy from here. I think it's important to kind of differentiate kind of what will happen versus the positioning and playing the game part. So I think in terms of what will happen, we would expect the coincident data to keep deteriorating from here. And normally the final leg of the kind of the sell-off or the final flush happens when the unemployment and the employment data both deteriorate, right? So it's more when the labor market stress hits, it's pretty unequivocal at that point that it's a recession. But, before we get to that point, the market tends to just do what it's doing, right? It tends to be resilient, trade sideways a lot. People over-position and can't hold on to the position. So I think we're going to be getting there. And from our point of view, we're still kind of waiting for that kind of final unemployment deterioration to really, make it obvious it's a recession. And that usually is the final flush. And then from there, you kind of have the usual, Fed will cut and, the kind of liquidity conditions start improving with a lag. And then obviously that sets up for kind of the next cycle.
Tian, let's talk about the scope and extent of that next move down. Some of our guests have said, okay, look, that 3,500 bottom was not the bottom. We're definitely headed lower. Other people are saying that was probably the bottom, but we might go back down, maybe, retest a double bottom or something like that. Do you see this as a new leg to lower lows, or do you see it differently?
Yeah, so obviously these things, there's a path dependence in terms of how we sell off. So the kind of more empirical way we've tried to approach it is we've had this market bottom checklist that we used to help guide us in terms of the timing. And so essentially what we did was revisited most of the bear market lows in the post-war period and tried to infer what are some of the common patterns you see. And so if you look at today, the kind of main missing piece is a kind of Fed monetary policy easing. So not just going on hold, but usually Fed cuts. And you also typically see lead indicators start to rally at the bottom. So those are usually the signs that would give you kind of the absolute kind of total conviction the bottom is in. And I think the problem right now is those things are not quite there yet. So, I think we're still pretty concerned that it's not necessarily in the all clear and that, it's important to be positioned in a risk off way. What I will say also, though, is that underneath the hood, there's obviously been a lot of talk about the narrowness of the market. So if you start to look at small caps, international EM equities, a kind of more single stock level, there's kind of a lot more stocks trading at much lower valuations. It's just more the headline indices are hiding kind of the damage done underneath the surface. So to us, it's probably already interesting to start rotating away from kind of the US large cap exposure to some of those pockets of value that would be aligned with kind of the longer term capital cycle. I think that that's kind of already underway. But yeah, in terms of overall risk, we're still probably more leaning towards, being cautious on equities and letting the market bottom checklist just play out. And until we have all the kind of all clear signs there, we probably won't want to take a structurally long position in equities.
Obviously, it's impossible to get the exact timing of this, but what's your best guess as to how much time we have left until that final flush of the major indices? Is it weeks away, months away?
Yeah, so I think this is actually probably going to be when the Fed actually cuts rates. So the really interesting thing is there's obviously a lot of debate right now about whether when the Fed cuts, it's going to be bullish or bearish for equities. I think there's a very good historical analog to today, which is kind of the 1969 to 70 recession, which was kind of a inflationary recession. So i.e. at the start of the recession, inflation is still reasonably far above target. And so usually with this kind of setup, there's limited scope for the Fed to act preemptively because just the political risks. So normally, as we saw back in 69, 70, and we think likely to play out this time as well, the Fed will probably be err on the side of cutting later than earlier, just to make sure that the hard economic data justifies them cutting. And I think that's going to be the problem this time, where if the Fed doesn't act preemptively and waits and only cuts after the hard data is very bad, then presumably the recessionary kind of feedback loops already well underway. So you have kind of another leg down in people's concerns about revenues, which then feeds through to the bottom line because of the operating leverage, inherent in these companies, right? And so you get kind of a final leg down in earnings there as well. So I think that's kind of the real risk. So I think timing-wise, we're probably looking for when the Fed cuts, but they're probably going to cut later rather than earlier. And I think that's kind of the big gap between kind of market pricing right now and the 69-70 analogy to how to trade today.
How long did that take to play out in 69 to 70, and what other lessons could be learned? That was a situation where you had, going into that setup, people were saying, look, hey, all these people talking recession doesn't make any sense. There's still inflation. You can't have inflation and recession at the same time. It doesn't make sense. And of course, it did make sense. They just weren't ready for it. So what else can we learn from that experience and apply to this market?
Yeah, it's actually, if you actually look at the lead up into it, there's so many similarities. You had the massive fiscal stimulus ahead of time that caused the inflation. So obviously we had COVID stimulus this time. Back then you had the Great Society, Lyndon B. Johnson, Vietnam War. You had similar setup where inflation was high going into it, but leading indicators already collapsed. The labor market was super tight. The Fed had been tightening for a while. It was also similar magnitude, 450 to 500 bit, that kind of range of tightening. Inverted yield curves. So that there's so many setups, right, that are similar, right? Including, by the way, equities drawing down ahead of the recession and then trading sideways at the start of the recession. And then kind of the final flush only coming kind of deep into the recession when the Fed cut rates. What actually happened back then was the Fed cut once the hard data, the labor market data deteriorated. But then because inflation wasn't quite under control yet, they then had to hike again very quickly. And that's what really freaked the market out. Because I think if the Fed cuts and then quickly has to hike, that's kind of the worst situation and certainly something they don't want to be in. So you would have to imagine today they probably learned their lesson from these historical episodes where, they really need to be sure before they cut. And so you can be fairly sure if they do cut, it's because the underlying conditions are really bad, in which case that's probably what drives kind of the final leg down. And also, by the way, if they cut, that does at least help to complete the market bottom checklist that we talked about earlier.
Let's go a little deeper on this subject of if they cut, it might not actually be good for equities. Historically, at least in recent history, usually when the Fed cuts, the market has interpreted that as a positive signal for equities. What's the explanation or the backstory for why this time might be different?
So I think it's more the broadly inflationary backdrop that we have. So I agree for most of the past 20, 30 years, right? Like it would have been better, but inflation hasn't really been as big a problem in that entire period. So normally the Fed cuts have usually been a lot more preemptive as well. So it stops a lot of the positive feedback loops we talked about that normally happen in recessions. If the Fed cuts early enough, they stop that happening. The danger this time is the Fed waits too long, and you have kind of the credit market tightness, lending tightness feeding through into job losses, which in turn then feeds into kind of revenues going down. Then in turn, obviously, that feeds more into kind of banks being reluctant to lend. Right. The danger is that in a recession, a lot of these cyclical feedback loops have already kicked in before the Fed acts, and so if that's the case, when the Fed cuts, it's not very easy to break these feedback loops because there's obviously a self-reinforcing mechanism in place. And I think that's the real danger this time around. And we would argue you're kind of already seeing it already, where activity essentially peaked in January. Since then, the kind of very slow rumble of kind of the unwinds already starting in terms of economic activity. And so that would be why, right? If inflation's high, the Fed cuts are not like preemptive, they're reactionary. And if they're reactionary, what are they reacting to? Almost certainly kind of bad labor market data. And if the labor market data is bad, and labor market data is typically kind of the most lagging piece in terms of the economic data set, then by the time you see it, things are probably already pretty bad.
So we've been talking about the recession cycle where we've still got the final leg or the final move down hasn't happened quite yet. We've translated that to an equity market outlook. Let's talk about what it means for fixed income, moving on to page 7 of the slide deck. How do we translate this outlook to what comes next in rate markets? Where are we headed? Is the final terminal yield in on the U.S. 10-year Treasury, or what happens next?
Yeah, so I think for bonds, this is also a quite tricky setup today. So I think a lot of times when we do analysis, we try to be explicit on kind of the time horizon. So on the cyclical kind of 6 to 12 months business cycle horizon, then yes, a recession is normally obviously good for bonds. It suggests kind of curve steepening as well. But on the kind of 2 to 3 year structural basis, I think we're still pretty concerned that we're moving to a decade of kind of structurally higher inflation, higher yields. And I think that's what's going to complicate the bond performance this time. And indeed, if you use the 69-70 analogy back then, yields do come off, but not that much, right? It takes until the recession is over, like well into the depths of the recession before bonds start performing. And I think there's an element of that concern this time around as well. So I think, yeah, bonds should do okay. Everyone knows the next move is going to be a steepener, but that's basically been priced into the market already. The forwards already uninverted, right? If you look at 2-10s forwards. So actually, I think fixed income is the one where people are going to expect it to help you, give you the portfolio protection, but it actually probably won't give you that much this time around. And I think that's going to be pretty painful for people as this recession really kicks in.
Moving on to page 8, something I expected, and frankly, a whole lot of other people did too, was we all thought, okay, the big event is China's economy reopening. That's where the floodgates open. That's what's going to change everything. And I thought that's really what's going to unleash the next wave of inflation. That all didn't work out at all as I expected it would. What's going on, and what do you see happening next?
So our China recession model actually only switched off in April. So I think at the beginning of the year, there was very little in our models and data that suggested China's activity was actually picking up. Maybe this was linked to kind of the political environment and the 2 sessions, needing to get kind of all the political kind of hierarchy aligned first before they can act. But now it's really April onwards that the data does start to confirm that things have bottomed. You're generally going from very bad to bad. And that's kind of a positive kind of cyclical shift. And against that backdrop, you've actually had Chinese assets, equities obviously underperform since peaking in January. So it's actually turning into quite a nice contrarian setup and actually sets up for quite a nice kind of long China versus short US RV trade that was very crowded at the beginning of the year. But now it's kind of being unwound and it's actually looking increasingly attractive now and is somewhat justified by the data.
So it sounds like you think the herd got the basic message right, but the timing wrong, and put this trade on. The market essentially priced in China reopening, changing everything before it was ready to happen. Is that the gist of it?
Yeah, at least on our models, that's what it looks like. Whereas now, if there's a bunch of indicators that show activity is bottom in China. It's not necessarily bonanza and booming, but I think compared to kind of how bearish the market price action has been and sentiment on China has been, it feels like a pretty nice contrarian kind of setup.
Moving on to slide 9, let's broaden the discussion beyond China to emerging markets generally. What's the outlook?
So yeah, I think we're still on the kind of long Brazilian debt trade. So from a top-down point of view, usually we don't think taking risk in EM makes sense when the global excess liquidity environment is poor. And as of right now, the global excess liquidity environment on our models is still quite poor. So within EM, I think we only prefer select pockets of risk. The kind of major outlier, the standout in EM is that our Brazil inflation lead indicators have like been collapsing to kind of probably historical lows on the models. So, they basically favor very strongly that, Brazil is going to have an easing cycle. And obviously the long Brazil bond trade started working in the past month. But that has a long way to go if Brazil goes for an easing cycle as well. So those are like the pockets where you're going to get a lot of carry, a lot of upside, and they make sense. But broadly speaking, for EM, I would frame it as cyclically. I think the liquidity headwinds are still there for now. We'll see how much China does pick up, and maybe that shifts it. As of right now, not quite. But structurally, what's interesting is that there has been a shift. So on kind of the longer term, 3 to 5 year structural capital cycle models, emerging markets are kind of finally capital scarce versus kind of the US, right? And that really only happened from the beginning of this year. So that kind of suggests on kind of 3 to 5 year outlook basis that EM is finally set up for outperformance. So I think our mindset is a little bit that ultimately we know we need to start allocating to EM, but we just want the cyclical to set up. But for now, things like Brazilian bonds are still look very, very attractive as a long.
Let's move on to the U.S. dollar on page 10. Let's start with a big picture here of where are we in this story. We had that big rally up to 116 on the Dixie, blow off top almost, and everybody thought it was all downhill. Now we're bouncing. Is this a dead cat bounce? Are we going to take out 100 to the downside on the Dixie, or are we seeing a reversal here? What's the big picture of where the dollar is headed, and give us the general outlook?
So I think the main issue on having a high conviction view I know Druckenmiller came out short the dollar, right? But like at least on our models, there's kind of two big counteracting forces right now. So firstly, as you mentioned, there's dollar smile framework, the idea that in a recession, dollar outperforms. That's one factor that's potentially being cited a lot for dollar performing. But the flip side of that is the commodity financing demands have collapsed versus last year. And usually that's been a very good predictor of dollar as well. So the problem this time around is they're acting opposite directions. So actually, it's not a particularly clean view on the dollar trade right now. So I think our mindset a little bit is right now it's not high conviction on the dollar, and we prefer to wait for the kind of US recession to become obvious in the data. And at that point, the kind of dollar smile thing will fade and the underlying kind of weaker dollar trends actually kick in. So we're probably waiting for that to actually time when to short the dollar again. And in the meantime, it's actually, we're probably just holding off and not having that strong a view. I mean, one piece that is interesting is still probably long dollar CNH. That's a trade that's been working well for a few months. It's broken above 7 today. We think that actually aligns well with kind of our China models as well, where as China starts to ease more, you'll get kind of a QE-like effect in China as well. So, as China tries to ease and try to pump liquidity in, that liquidity actually can't really be accepted by the private sector economy as much. So actually that has kind of this effect of boosting Chinese asset prices, but also actually putting downward pressure on the currency. So yeah, long dollar CNH, these trades still, probably do make sense. But overall on the dollar, I think, it's tricky on our models to make a big call right now.
I love the title of slide 11, U.S. high yield still complacent. Boy, that's got to be the understatement of the century. The thing is, I think it's been pretty clear that U.S. high yield was complacent for years now, and it never seems to stop being complacent. What's the trade here?
Yeah, I think one of the interesting things that we've been highlighting is potentially looking at ways to gain exposure to shorting leverage loans as kind of the higher beta version of this that's more likely to go wrong. Obviously, broadly speaking, we know that spreads have been relatively contained, but the yield has picked up just because of where risk-free is. But it does feel like if we get a NPL cycle, our recession models are correct, that there is kind of deterioration coming, then obviously the credit complex in terms of high yield will be hurt. But the most vulnerable parts are actually in the leverage loan space, because it's been companies that haven't been able to issue bonds into the market, right? Who've had to take on these leverage loans. that particularly vulnerable. And, we've done some work there. And then in particular, if you look at some software companies, tech leverage loans, they generally have pretty weak covenants. And if there is a recession, revenues get hurt, and you make a leverage loan to a software company, there's not even like any assets to recover, right? If that business is broken. So yeah, that's probably the piece that's actually very acute to short. But obviously, we all know the credit spreads haven't quite moved yet. I think we're waiting for the NPL cycle. We're waiting for the evidence recession to kick in. And, we think that's actually pretty imminent. So yeah, shorting leverage loans seems like a very clean expression.
Tian, a lot of us, myself included, believe that a new commodity supercycle is upon us to the upside. So bullish commodities. You're describing on page 12 a commodity supercycle intermission. What's a supercycle intermission, and how long is it going to be ongoing for?
Yeah, so I think back in 2020 we did the podcast on the commodity supercycle back then. So I think that
you nailed the call, by the way.
Thank you. I think back then a lot of the models actually did point to kind of the cyclical and structural and tactical all aligning on commodities. So it was kind of a, all clear, all green lights kind of setup. And I think from actually when we spoke last year in May, right, that was basically when we talked about the supercycle intermission starting. So I would say the 3-year cyclical, capital cycle model, capital scarcity models, they all still valid, right? I think we're all in agreement. Like it's a very, very good setup. There's, lack of capex, supply constraints, and so forth. But the problem has been that we want the cyclical headwinds to kind of play out. We kind of need the tactical trades, tactical indicators to clean up a little bit. And I think we're almost there. Obviously, we talked about China recession potentially ending. I think the US recession will become obvious soon. So from then, the cyclical kind of will bottom out. And certainly in terms of flows and positioning, it's much, much cleaner of a trade now. So I would still say kind of structurally we're bullish, but because of the kind of cyclical headwinds, we still say the intermission is kind of ongoing. We're not quite there, but it feels like there'll be opportunity in the second half to kind of get back in on the kind of commodity supercycle trade again.
And finally, on page 13, you're describing gold as being in an LPPL bubble that might be ending. For the benefit of any listeners not familiar with LPPL, please start by describing that indicator and then tell us more about what's going on with gold.
Yeah, so I think LPPL is one of the most important tactical trading indicators we have. It's very critical for us in terms of market timing. And essentially, it stands for log periodic power law, originally popularized by Didier Sonnet. And the idea is that it's trying to pick up on inherent kind of crowding and herding behavior in markets. And, it's basically computationally pretty intensive. And normally the models are not very stable. We've basically been spending a lot of time on optimizing it to be more stable. And essentially what it's really cute about the indicator is compared to kind of normal buy-sell signals where you just get kind of the on-off, it actually can fit the current price pattern and predict kind of end dates of moves. So it's not just a reversal signal. So I think gold was like the price action as being a very, very classic kind of bubble-like price action where, as we see on the chart, I think we first detected kind of the final leg of this bubble April 25th. So normally it suggests you kind of have one final upside leg, but the model is very cute because it gives you like a predicted end date for when the move ends. Generally speaking, you can calculate the end date by cutting off the pattern, right? Ultimately, it's like it's what you say. It's like an asymptotic fit. So the blue line at the end will obviously go vertical, go to infinity basically, right? We just cut it off, but it essentially gives you an end date for when a bubble ends. And so that becomes very, very good to help with structuring trades. So essentially the way you would interpret that right now is, gold from a structural and cyclical point of view has made sense, right? It's been kind of our core allocation since beginning of the year. But from the price action point of view, it's, especially last week, it's felt like sucking in the very last kind of speculative buyers, right? The buying's got increasingly disorderly. People are desperate to get on the trade. And so that's why the LPPL kind of bubble triggered. It kind of predicted to end on Friday. So from here, there's probably a decent risk of a pretty big tactical flush, just because the position is probably very extreme in terms of speculative buying. But ultimately, I think if we do get a flush, right, we're kind of waiting for that, and then we'll look to reestablish long gold trades. But yeah, it feels like we could be in for a pretty decent tactical flush here.
Well, what you're saying definitely resonates for me because I am long gold. And throughout this rally, I've just been feeling like, okay, this is a little bit too easy here. Feels like we need to see some kind of move to shake the weak hands out of the market. So when you say this could be a substantial shakeout or leg down, how substantial are we talking about? Looks to me like the most obvious downside target from here would be the 100-day moving average at say, 1931 or so. Are we talking about that kind of down leg, or are we talking about much deeper than that?
Well, I think certainly that's the initial target. Obviously, again, there's going to be a path dependence to potentially triggering losses. So I think we're relying on some of our kind of speculative flow proxies to kind of give a better sense of the downside. But yeah, I think 5% plus is probably not unreasonable. Like GDX also looks particularly vulnerable as well, because on GDX you can at least use the underlying stocks to proxy for kind of actual equity flows and get a cleaner number. And that also looks pretty extreme, right? With like a 10% potential downside to start with. So yeah, I don't know the exact amount, but certainly I think we're just positioned to capture kind of a tactical downside. We'll let some of the speculative flow data tell us when it kind of reverses. But obviously this is more of a tactical view, right? Like next 1 to 3 months, I think we're all still pretty aligned. If you talk kind of 2 to 3 years out, we have our age of scarcity thesis, right? Obviously we talked about structural high inflation environment and those kind of things. So still ultimately I think gold's a good investment, but it's just this flush could be it's just too crowded right now. It feels like it could be a decent flush.
I definitely agree with you there. I've been waiting for some kind of significant correction to occur, and seems like maybe it's starting. And Tian, that covers the slide deck, so let's move on to the banking crisis that everybody's talking about. Some people say it's already over. Some people say it's just getting started. How do you guys see this? What's driving it, and what should we expect?
Well, I guess from the macro point of view, when we think about the credit cycle, it's generally got some pretty well-behaved leading, lagging relationships. So typically what we expect would be that the main long-term lead for the credit cycle is actually the yield curve. So typically you get kind of yield curve flattening inversion about 18 months before credit standards start tightening. And then once credit lending standards start tightening, it takes about 6 months to flow through to kind of the actual underlying loans and loan demand as well. So from that point of view, it's kind of been coming for a while, right? Yield curves inverted kind of 18, 24 months, however it is already, right? They've flattened and inverted, and lending standards already been tightening before the kind of SVB and these things kicked off. So I think that the reality is like the credit availability has been bad for a while. But usually when these things happen, we tend to think of it as like a proximate cause versus a fundamental cause. So a lot of times it's easy to focus attention on kind of the proximate catalyst and lose sight of what's being the fundamental setup. So I think fundamentally, our capital cycle models have been saying banks have been capital abundant from pretty much Q4 of 22. Last year, it's just been too easy a ride for banks for too long that they've just had to, there's just not been kind of enough incentive for banks to run kind of a kind of efficient business model, right? Like they basically it's been an environment where the capital cycle suggested that it's being very capital abundant. They've had to take on more risk to make money. And so I think the fact that something happened in the banks is probably not surprising. Obviously, we do not predict the bank run, and it's hard to know exactly what specific issue comes out. But fundamentally, I think banks were set up for underperformance this year anyway. What is particularly interesting, I guess, from going back to trading and from a dislocation point of view is certainly this latest leg of the sell-off is causing some very, very extreme price action where, if you look at out the money puts and the implied vol on the banks, right, it's been on even say the KRE ETF is going up to like 50, 60 odd implied vol. But at the same time, a lot of the kind of usually very correlated assets have not seen kind of the same surge. So it actually sets up for a lot of very interesting kind of relative vol plays. Obviously, banks we're recording this today, and there's been a pretty big rally. But if you just go back to the end of last week, and if we get another flush, you should be pricing up, say, like a 30 strike put on KRE and these kind of things, right? Just to get a sense of the premium, because that would take you back to kind of the COVID lows. And with the premium, you can basically buy a lot of very interesting option plays in related assets. So, one of the trades we liked and the last week being this week was actually a put switch where you could basically get 4 times the notional in kind of Euro stocks puts for 1 in the KRE puts, right? So there's these kind of very interesting vol dislocation put switch trades that's setting up right now that can give you kind of a very interesting tail risk trades. Other than that, obviously, there's been some dislocation as well in terms of the credit space. So with the banking crisis, you are starting to get some investment grade kind of financial debt starting to offer higher yields. So I think that's worth sifting through to pick up some pockets of value. But yeah, that's probably how I would frame it right now.
Well, Tian, I can't thank you enough for a terrific interview. I always enjoy variant perceptions, graphs, and charts. Before I let you go, though, Tian, I want to talk a little more about what you do at Variant Perception and how our listeners can find out more about it. You guys have been known for a long time as one of the best research firms in the business when it comes to leading indicators. You guys use some of the well-known leading market indicators. You also have designed your own leading indicators, which you use in your research. We investors only get to see those on Variant Perception slide decks. There's no way to use those indicators directly as an investor, or at least there didn't used to be. What's going on? What's changed? What are you guys working on?
Yeah, so I think we hear you, and I think the issue usually has been that, for clients, how do you build confidence in our lead indicators? What if we don't show one this month and we show it next month? So I think to address that, we've essentially built a new investment portal for clients to essentially interact with all our different models. So, in a way, the research becomes how we interpret the models. But if you wanted to see the underlying models yourself, now you can, from kind of the market timing, tactical trading tools, LPPL, these kind of systems, through to the lead indicators of, growth, liquidity, recessions, but also some of the kind of longer term, capital cycle models that help us pick stocks and sectors as well. So I think it's just an attempt to kind of add more transparency and let clients play with the models a bit themselves rather than just relying on us to interpret it, basically.
That sounds really exciting. Tell me more about who gets access. Is it just the institutional advisor client base, or is there a retail platform as well? Who can get this, and how much does it cost?
Yeah, so I think if we break down the investment process, it's essentially collect data, right? Step one, process that data. Step two, and then ultimately interpret it to make an investment decision. So I think we've tried to streamline what we do a little bit more to address each of those steps. So kind of the traditional research is still like an institutional product, right? Where essentially you want us to collect the data, build the models, and interpret it. But the idea now is we can move it kind of up one step where, maybe you don't like how we interpret it. You want to take the models and feed it into your own process, in which case you can just access the portal, play with the models yourself. Or even if you want to go one level higher, it's, you can get the API and feed the data feed in directly. So I think it depends a little bit on the level of service and interaction you need. But broadly speaking, I think we still basically position ourselves as probably more for kind of institutional investors, just because ultimately there's a lot of models here. And I think we just want it to be plugged into the right pieces. But I think certainly we try and put out a lot of free content as well, especially educational type things on Twitter, on our blogs. So, that's definitely going to continue.
Okay, so if I'm an institutional investor, I previously had the opportunity to use your indicators without really getting too close to them. Now I have the opportunity to both use your research advice, but also get, roll up my sleeves and play directly with these indicators, backtest them and so forth. And if I want to do something in the area of algorithmic trading, all I have to do is hire a programmer to use your API, and there's a programmatic access to these indicators as well. Is that the gist of it?
Yeah, I couldn't have described it better myself. So yeah, thanks.
Fantastic. Well, Tian, I can't thank you enough for a terrific interview. Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, what a great interview with Tian. Now joining us in the post-game segment is Nick Galarnik. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Tian's picture that says Looking for the Downloads. Erik, let's cover crude oil starting with the EIA inventory numbers.
EIA printed a massive 5 million barrel build on commercial inventories. But hold on a second. It was really only a 2.5 million barrel build because another 2.4 million barrels was pilfered out of the Strategic Petroleum Reserve this week. That's the 7th week in a row that we've seen a drawdown from the Strategic Petroleum Reserve. 12 million barrels over the last 7 weeks have been taken out, and this is at the very time that they promised us they would be refilling it. Needless to say, our predictions here on MacroVoices that refill wasn't really going to happen as promised are already being proven right. Cushing, Oklahoma, building a massive 1.5 million barrels. That's a very big build for Cushing in a single week. I'm guessing there must have been some kind of disturbance on the pipelines that caused that accumulation of oil, but I don't have any specific data to explain it. Gasoline drawing down 1.4 million barrels, and distillates building a de minimis 80,000 barrels. U.S. production ticked back down 100,000 barrels to 12.2 million barrels. Tape action was up after inventory despite the build, taking us above the short-term moving averages, above the 200-month moving average, and starting to test the 21-day moving average up at 73.27. So we're above the short-term moving averages. Maybe that means there's hope for a new uptrend. But after so many of those uptrends have failed before and the recession signals are now getting louder and louder, I see plenty of room for another leg lower before the bottom is in for this market. And the 100-month moving average all the way down at 59.47 is the most obvious target that I see on the WTI chart. My original forecast that oil prices ought to be rocketing much higher by now has clearly been proven wrong. But I haven't changed my view on the underlying reason for my premature call, and I still forecast that an explosive move higher in oil prices is coming eventually. But with recession signals gaining traction and China's recovery not resulting in oil demand growing as quickly as expected, it's entirely possible that oil prices drift lower for another year or longer before what I'm talking about eventually takes hold. But I'm not abandoning my view. I'm convinced that it will eventually take hold. Now, I've described this before on MacroVoices, but for the benefit of any new listeners, let me just lay out my basic supply-side thesis, which is I think that the most important moment in the history of the modern oil market will probably occur in 2023 and go completely unnoticed. The event that I'm talking about is the world running out of spare production capacity. The reason that this monumentally important event is likely to go completely unnoticed when it happens is that if demand is declining, then the market's inability to accommodate an increase in demand will not be tested. Nothing will happen, and oil prices might just continue to drift lower. But someday the recession cycle will play out, and demand for crude oil will return. That demand will not be met because we simply don't have the supply. We don't have the inventory cushion to absorb a big supply-demand imbalance, nor do we have the spare capacity needed to increase production in response to higher prices and increasing demand. Crude oil prices are famously inelastic to supply to start with. The reason is that when you have plenty of spare capacity, it takes time for higher prices to transmit to a human decision to increase production, and then there's a lag time for that increased production to reach first the country that the oil is being delivered to. It's got to go through the refining process. Finished products have to be delivered to whatever city they're going to be consumed in, so on and so forth. Even when you have plenty of spare capacity, this is a challenge. But when you don't have any spare capacity, and this is the first time that the oil market is going to confront a situation where it doesn't have any spare capacity, higher prices don't transmit signals that increase supply. They just keep getting higher and higher and higher, and there is no supply to increase. And I predict that that's exactly what's going to happen the next time that the market is challenged to meet an increasing global demand, something that we don't have right now. The market will fail that test, and then we'll have an energy crisis on our hands. But none of this gets triggered until the market's ability to respond to increasing global demand is tested, and we don't have that test yet. Some people think that global oil demand has already peaked and begun an irreversible decline. Now, if they're right, then the market event I'm talking about might never happen. But if they're wrong, and I think they are, then we're headed for a global energy crisis by 2030. Now, this whole thing is reversible with a change in policy and more investment in E&P. But there's a multi-year lag time for that fix to be applied. And during that lag time, nothing can be done to stop the global energy crisis that's going to happen during that lag period. I thought this was all going to start this year. I'm starting to think now that we're going to have a year or more of recession before it eventually hits the tape. But I remain convinced that eventually we're going to see increasing global demand that cannot be met with increasing supply, and it's going to cause a major, major price dislocation.
Yeah, it's been interesting price action, Erik. Obviously, the lows from March held on the test, and crude oil is really settling in and bouncing off of those lows. But to me, the real test is whether or not it can come back into that trade range in the high volume node zones that were established through December and January, February, March. And if we see crude oil here fail to make any push deep into the mid 70s, then it's still technically quite weak. And the window can still remain open for one more retest on the downside, in my mind. Overall, there will obviously be a point where crude oil will bottom and create a buying opportunity. But at minimum here, if the bulls want to give it a shot now, they're going to need to get back into this trade range. And that's 100% what I'm going to be watching going into next week. Nonetheless, let's move on to equities. Before we get to you, Nick, in terms of the levels, I wanted to get your thoughts here on the markets, Erik.
No big change from last week. I think the next big move for stocks is going to be down. But I won't be surprised if they drift up first. Now, if that happens, my target is around 4309, which is the 61.8% fib retracement of the overall bear market. I don't think it's going to go much farther than that, but let's see what happens.
Yeah, Nick, on page 3 here, we have the S&P 500 levels. What are you watching going into this week's OPEX?
Yeah, Patrick, the spot right now on SPX is 4160 with a call wall above at 4200 and a put wall below at 4000, which has moved up from the previous level by about 100 points or so. The implied move for the June 16th OPEX is plus minus 140 points. So the upper expected move is 4300 and the lower expected move is 4020 roughly. Key resistance above is 4200 and then 4300, which is also the year high. And key support below now is 4150, then 4100, then 4050. Again, I mentioned last week that I was bullish in the short term, and that's still the case. I think we see upside toward 4,200 or so, but that may not transpire until after this Friday. I think volatility will pick up a lot in the coming weeks as we approach the June OPEX as well. And I'm also noticing that there's a serious skew right now to the upside with the calls and the puts. The calls are much more expensive than the actual puts right now by a factor of about 13% or so. So that's kind of interesting to note. I attribute it to a factor that right now, a lot of funds are underinvested in equities, so the hedging requirements are not as high. So the put buying is not as necessary for hedging purposes. So again, right now I'm short-term bullish, but I'm a long-term bearish. I think we can touch that 4,000 level in the next few months as well, and then possibly test out the 3,800 level again, which we saw a few months ago.
Yeah, on page 4, I have the S&P 500 chart. And the one thing, while we were talking about how heavy the market is and how weak the breadth has been, that was a part of last week's postgame. The interesting thing here is that the pain trade, actually, in my mind, is really the market first going higher before it goes lower. There's clearly every reason why this market has a chance to go down during a recessionary period. But it going first towards 4,300 to kind of just wash out all the shorts and to sucker in a bunch of new buyers up to push it up to the upper zone is still, I think, the path of least resistance on the short term. The 4,100 level is a really interesting place. It's where that 50-day moving average is. And I think overall it's an area where it'll be the first sign that some sort of reversal is underway. And right now we're nowhere near it. So it'll be, let's see whether the bulls can follow through above this 4,200 overhead resistance. Nonetheless, let's move on. On page 5, we have that NASDAQ QQQ. What levels are you watching?
So spot right now on the Qs is 332. We have a call wall above at 335 and a put wall below at 310. The implied move for the June 16th OPEX is plus minus 13 points. Upper expected move is 345. Lower expected move is 319. Key resistance is just above the current level at 335, and key support is at 310, also where that put wall is right now. Again, big tech has been carrying the market higher for the past few months, really for the past year actually. And looking at Google, Microsoft, Apple, Amazon and Meta, they've been carrying the brunt of the load overall. I believe when I analyzed the equal weighted index versus the current index, you can see that right now, most of the gains in the market have been attributed to just about 5 to 7 companies or so, with NVIDIA and AMD being part of that number as well. But right now, again, I'm bullish as long as these names hold up. But the one thing that concerns me is looking at Apple and Microsoft, for example. They're near all-time highs right now already, whereas their valuations are much, much more expensive relative to previous years when they hit all-time highs, because their earnings are actually lower than they were prior. So that to me is a bit of a concern going forward. And I think that we could see some downside perhaps if these big names start coming down or stagnating overall.
I have to agree with you. The only thing I think that can really get this market up to 4,300 and 4,400 on S&P is if the breadth widens. Really, those mega cap stocks are pretty exhausted. It's not that they can't go higher, but it'll be really hard for them to continue to carry all the weight. And so it's interesting, on page 6, I have the Russell, and the small caps have actually upticked yesterday and over at least the last couple trading sessions. And a part of that, I think, is a bounce in those regional banks. And so if there was going to be an impulse higher in the short term, it could and should likely come on the back of a widening breadth of the market. And if it doesn't, then I don't really know if the market will have enough gas in the tank to make that push. Nonetheless, let's see whether or not the small cap rally sticks. On page 7, I want to move on, though, to the volatility. The VIX down in the 16 handle, holding down along the bottom of the range. What are you thinking here, buddy?
Yes, looking at the VIX, again, right now, as I mentioned in past weeks, I don't really attribute a lot of importance to it as I do to the 0DTE, so the one-day VIX right now, because we're seeing about half of the flows come out for 0DTE options. The VIX right now is at about 16.76 or so, almost about 17, which gives us an expected move daily of about 1% in broad indexes. So right now, that 20 area is very important. We spiked a couple days ago to that 20 area and came right back off of it. It's possible we go lower as we grind higher to that 4,200 mark on SPX, or even 4,300 perhaps. But it's much, much harder to swallow the pill of selling premium when it's not that high right now. That is the VIX, because the reward isn't that great for the risk being taken right now. Until something happens, some catalyst event occurs to spur some downside, I don't anticipate on a huge spike in the VIX. I think we can kind of stagnate in this area and kind of slowly grind higher perhaps in SPX, while the VIX kind of remains in a very inert phase overall. That's my perspective in the short term. Again, if we get above that 20 area with some gusto to the downside in broad markets, it's possible we spike to 25, 26, and then depending on the catalyst event, it's possible we push to a 35 handle or so. Now, moving on to the US dollar index on page 8, what are your thoughts here?
Well, clearly the dollar is firming up, but there's a big difference between firming up and declaring a new uptrend. We need a daily close over 105 on the Dixie to declare a new trend, and we don't have that. So we're still consolidating in a fairly wide range between 100 and 105 until proven otherwise.
Yeah, my view on it was that the dollar was going to put in a short-term low, even if we had a quick little drop down to the 100 level. And my overall view is that we are far more range-bound. But what'll be interesting to see is if we do have some sort of a indication that, that a recession is actually here, if we do have a risk-off impulse, will it drive a short-term dollar impulse that could even break this trade range and even head to a little bit of a higher level like 107 or 109? While I understand that overall the dollar likely will, in the years to come, weaken off of these levels, the question here is whether or not it first has a journey to the upper boundary of the ranges before it goes down. Nonetheless, this 103, 104 level is where there's a lot of fib zones. It'll be interesting to see what the dollar does as we approach a typical retracement area.
Now, guys, moving on to page 9 here, we have the gold futures chart. What are you guys thinking here?
Well, now things are finally starting to get interesting in the gold market. As I've been saying for several weeks now, just breaking out from here to new all-time highs and up and away would have been far too easy. The fundamentals for gold are excellent. But as Tian Yang said in the feature interview, long gold has become a crowded trade. I wasn't aware of the LPPL signal predicting a top on gold last Friday until this interview, but it fits perfectly into my own view that the market needs a painful correction to shake out the weak hands before a breakout to new all-time highs can be sustained. So now it seems the long-awaited correction is on, and the question becomes, how low will it go before bottoming and moving higher to reassault the all-time highs later this summer? My chart shows the bottom of the price channel and the 100-day moving average approximately co-located around 1931, and that's been my target for adding to my longs. But Tian's scenario of a deeper correction makes perfect sense. Everyone knows that the fundamentals for gold couldn't be better, and they're right about that. But they're all right about that on the same side of the boat, and that always spells trouble. Right as they may be, I think some of them are perhaps about to take a swim. So it makes sense to keep some powder dry in case of a deeper correction.
Yeah, Erik, overall, that 1930, 1925 area is an area of high interest for me as well on the first pullback. But in my mind, if we go through a bigger risk-off impulse, I think that the vulnerability of gold even pulling back to retest March lows near 1800 is entirely on the table. But I'll have to be in the stance that I remain quite bullish in the bigger picture. And if we had that deep of a pullback, it would be a compelling and a tactical opportunity to reposition on the bull side of gold. So it'll be interesting to see how that plays out. Nonetheless, I want to touch on page 10, 11, and 12 of the grains. I have wheat, corn, and soybean futures. And what's really interesting to point out is just how incredibly weak the grains have been. They're breaking down, many of them to fresh lows, and just continue to be incredibly weak. This continues to contribute to the overall weakness in the Bloomberg Commodity Index, as everything, including oil, have been pressing that index down. It'll be really interesting to see whether that break in the commodity index will inevitably result in a buying opportunity that will arise in the second half of the year. But right now, these trends are distinctly down and very weak charts that continue to leave the downside window open.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, as well as Tian's slide deck and a chart book that we just discussed here in the postgame, and a link to a number of articles that we found interesting. So you'll find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter @Erik S. Townsend, that is Erik spelled with a K, and follow Patrick @Patrick Ceresna. On behalf of Erik Townsend, Patrick Ceresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.